Thank you, everybody, for joining us here today. I am very happy to have with us Mark Halpern. He's a CFPT PMFAP. I'm assuming that P means philanthropy. Is that correct, Mark?
That's correct, Joe.
Oh, well, we're so happy to have you here. Now, just to give a little bit of a background for everybody who doesn't know Mark already, and he is a famous fella, especially in the Greater Toronto area. He is a specialist that focuses on insurance with an eye to taxation. He has been on many news stations, many interviews right across the country, but mostly in the Toronto area. He has spoken at a number of conferences. He's a highly sought after guest. He has, for example, spoken at the $1 Million Roundtable, the World Critical Illness Conference, KALU Advocates, and a ton of other ones. He's a member of STEP. He is also a professor. He teaches leadership and business ethics courses at the University of Toronto, York University, Ryerson University, University of Western Ontario. And actually, Mark, at one point I was looking to go do my MBA in Schulich School of Business with a focus on sustainable development was one of the places I was looking at. So we might have met at that point, but we never did. Regardless, some of the other things that Mark has done, he is also a frequent contributor to Tax Letter, which is a publication known right across the country, giving tax planning techniques. There's a focus on insurance as well there, but a number of other tax specialists across the country are definitely involved in it. But today, our topic is not just tax, but insurance. So Mark, I just wanted to welcome you to the show. How are you doing today?
Thank you, Joseph. I am well, and the weather is beautiful here. So I think that's getting us all to feel good, get out of that seasonal depression where it's been dark and gloomy over here in Ontario for a while. And we're managing through COVID and all the things that are going on with the economy and world events as well. But thank God we're busy and doing well. For 30 years of professional practice, we've been trying to convince people they're going to die or get sick one day, and nobody seemed to believe us. So suddenly there's a global plague, and everybody is much more aware of their mortality, and also the fact that they have a lot of incompletions around tax, estate planning, insurance, and around their philanthropic footprint as well. So it's been a very busy year for us. We've been very grateful.
So, Mark, we know you've been involved. You've done a lot of planning work, especially in respect of insurance and taxation. You've written a number of articles in various publications. You've been in, I believe, the National Post, the Globe and Mail, many large national publications. But I would like to start a little bit about you personally, and I'd like to, if possible, can you just tell me a little bit about yourself and why philanthropy is such an important part of your practice and professional life? Like, how does it all fit together?
Thank you, Joseph. Yeah, like I said, I've been in professional practice for 30 years, but my real start, Joseph, actually started in 1974. So it's 47 years ago. Is that 47? Yeah, hold on. Yeah, about that. That's the year that my father of blessed memory died of a heart attack at the age of 50. I was 11. I was the youngest of four boys. And my mother at the time, who was 48, had to go back to work to support our family. The reason was my father was a very busy engineer, and unfortunately there was no will, there was very little savings, and there was no life insurance. So it was very hard for us growing up. But fast forward, I now work with some of Canada's most successful business owners and entrepreneurs, incorporated professionals, some sports celebrities, and wealthy families. And you would think they'd have everything all organized themselves, but I would suggest that 80% of the time it's not true. They're so busy looking after so many other things and other people that when it comes to themselves, they don't have up-to-date wills or shareholders agreements or insurance funding or proper structures in place. So we spend our time working with our clients and working with collaborative arrangements with other professional advisors in three different areas. One is in estate planning, just making sure that people's financial architecture and the furniture they have aligns with their existence, their reality today. The second area that we're involved with is in tax minimization strategies. So helping people keep their taxes for themselves as opposed to writing big checks to the government. And the third area is really in the area of philanthropy, Joseph. And that's where we help people create enduring legacies, often by converting taxes into charity. And it's become a very big part of our professional practice and something we're very proud of.
So when you're talking to a prospective client about your practice, how do you convey to them about how philanthropy fits into your approach? What do you say to them?
Well, look at it, it's an area that's very hot right now. Like philanthropy is hot because we don't have a lot of tax shelters in Canada, and the government makes it very easy for people to be philanthropic to save taxes. So it's definitely something that people have to be aware of, and they're not. Unfortunately, there's not enough information coming to them from charities or through professional advisors who really, this is not their wheelhouse to sort of speak to their clients about this. So we get very excited because it's really about providing people with wisdom and knowledge in an area that that they could really make a difference. And today in particular, Joseph, we have a lot of clients who have done very well, so they've become very successful, but maybe they haven't become significant. In other words, they really feel that they want to give back in some more meaningful way. And as a result, we explain to everybody that we meet, and it's part of just any comprehensive estate and financial planning, that there has to be a piece there for strategic philanthropy. And the way that we introduce it, Joseph, is we say every single Canadian has three possible beneficiaries to their estate. You have family, you've got the tax department, and you've got charity. And each of us can pick two of those. Which two would you pick? Most of our people that we speak to say they take family and charity. So we explain that with proper planning, you can be remembered for leaving a big check to charity as opposed to writing a big check to the tax department. And this would be a process, something that would come out of the discussion as we're looking at the overall tax and estate planning.
Yeah, that's a really good point, because effectively with the charity, you're directing how those funds are spent to some degree, whereas to the government, it goes into just a larger pot, and the politicians essentially decide. So I can definitely understand the allure there. But I'd like to just sort of get a sort of a real tangible picture of how this actually works in your practice. Can you give me a specific situation when you really felt that you've been able to take a proactive role in getting your client engaged about giving, and how did it happen, and what happened?
So I can give you a recent case, and again we have many dozens of these cases. I'm on the advisory board at 4 hospitals and for a community foundation. But I'll just give you an example. We got introduced to a family that sold $120 million of real estate, and after all the planning was done, they still had a $20 million tax bill, which is not so bad on $120
Sorry,
million of real estate.
Art, can I get you to hold your phone or flip your phone back over there?
Like this.
Yeah, there you go. Yeah,
Okay.
thanks.
So
Oh, there we go.
yeah. Okay. So they sold $120 million of real estate. They had a $20 million tax bill, and they were resigned to paying that $20 million of tax. And another advisor had asked them whether they would consider being philanthropic, or if they are philanthropic, and if that would be something that would be of interest to try to mitigate some of the tax. So I was introduced to them. And instead of paying the $20 million tax bill, what we did was we set up a private foundation for this family, where they took $40 million of that 120 and donated it to their foundation. That $40 million contribution allowed them to offset the $20 million of tax that was due, because for the people on this call who are really CPAs and the gatekeepers of their clients' wealth, the year that you sell a business or you sell some real estate or appreciated securities is also the year that you can be your most philanthropic, which was the case here. So they put $40 million into a private foundation. And now instead of $20 million of tax, that became $20 million of charity. But still, the family, the kids are out of pocket $40 million, right? Listen, it's a big number. And what we did, though, was we then created a strategy utilizing life insurance on a joint last to die basis in order to put the $40 million back into the pockets of the beneficiaries. And we used a financing or immediate premium financing strategy that allowed them to have the insurance in place, yet still have use of that money for other investments. So the net, Joseph, is that we took a $20 million tax bill and turned it into $20 million of charity. And then what we also did was we created a mechanism to get all of that $40 million donation back into the hands of the children. And we did that with a financing arrangement utilizing insurance to keep the costs at a minimal. So that would be, we call that, in our world, we call that becoming an accidental philanthropist, Joseph. And accidental philanthropy is really how most of our cases come about. I wish I could tell you people call and say, Mark, I want to give $10 million to charity, or I want to give $5 million to charity. Yes, that happens. But most of the time we're finding the money for our clients, or for professionals and their clients in order to become charitable and reduce taxes.
I find that fantastic. Mark, if possible, I'd just like to dive into that scenario just a little bit more, just so I understand it here. So the bottom line here is, without sort of the life insurance planning, what would essentially have happened is you're either out $20 million, so you got 100 million left in your pocket to distribute. So that's one possibility. The other possibility is you give $40 million to charity, which eliminates the tax debt, but you're now out of pocket $40 million. So that means you got 80 million left. But then you were mentioning we could use an intermediate financing arrangement in order to essentially move us from that $80 million net at the end of the day back up to $100 million. Can you explain a little bit more about how that works?
Absolutely. Look at, we don't have a lot of tax shelters or a lot of tax efficiency. It seems to be getting, more things are being lost or taken off the table, other than your principal residence, right? Which again, they're looking at taxing at some point, and maybe TFSAs, which are small amounts that you can put away, and lottery winnings. If you win the lottery in Canada, you don't pay tax on that. Life insurance is still in the Tax Act as a very efficient tax exempt structure to be able to provide liquidity to estates who perhaps have a tax bill, or they want to have money for inheritances, or they want to use it for charitable purposes. And in this particular case, what we did was we use it as a way of replacing a donation to charity. So in fact, the family is never out of pocket. It's just a timing issue. The $40 million that they put into their foundation would come back to them through the life insurance, with the beneficiary being their family, right? So the insurance policy in this case was a joint last to die insurance policy. So it was on mom and dad. And what they did was they used something called immediate financing or premium financing, where they put money into the insurance policy, and then they used the cash surrender value in that policy to borrow that money to put back into their investment portfolio. It could be back into your business, back into some real estate, or back into some other investments that you're doing. Because you're borrowing to invest, you get to deduct the interest for that loan and some other ancillary costs, the net cost of pure insurance. Now you're servicing a loan, but you've got your money, but now you've got this insurance policy that will eventually pay out on the second to die of mom and dad. In this particular case, the policy continues to grow in value, such that upon their death, the principal amount that they borrowed would be paid back first to the bank, and the balance would go to their estate. So really what they've done is they've really become even again in terms of the transactions they've done, in terms of putting money into charity, having it be used to mitigate taxes, and in fact repatriate that money back to their family through the insurance structure.
So it's not the policy itself that would be donated. Um, the,
No, no, in this
oh,
case, no. In this case, there are different ways that insurance can be used for charity. In this particular case, they donated cash, because an insurance policy donated would not offset their current tax situation, right?
yeah,
They
that's
need
right.
to they needed to donate cash into that foundation in order to get that charitable receipt. But when it comes to life insurance, Joseph, just so you know, there are different ways to benefit. One is you could have a life insurance policy where the owner of that policy is a charity, in which case the premiums you pay would be considered charitable donations. So you can be recognized for a very large donation that will pay off upon your death, but you're benefiting along the way by getting a charitable receipt for each of those premium payments. The other way that insurance can be worked for charity is, instead of getting the charitable benefit on the premiums while you're alive, you could pay those you could pay those premiums, but have the policy be the beneficiary of a charity, in which case the charity would get this large check through the insurance proceeds upon your death, in which case your estate would receive a charitable receipt for that large insurance donation, which could then be used to offset estate taxes. That's really the
So,
mechanisms of insurance and charity.
so really, there's sort of a timing difference between the two possibilities: an immediate donation receipt versus one at the final sort of giving of the policy, the payout.
Correct. And there's no cookie cutter here, Joseph. Like, everything is, this all comes back to planning, really looking at our client situation from 30,000 feet up. What I've noticed, and I'm sure a lot of your listeners will have noticed as well, is that in my case, my clients have passed this point in their professional life that unless they were to invest all their money in a penny stock or start spending frivolously, chances are they're going to have more money when they die than what they have today. So really, they're sitting on money as the custodian or trustee for the next generation. What they're not aware of, though, is that they are investing with a silent partner called Revenue Canada, the CRA. So it's very important that people look at things where there's more planning than investing. It would be great to know today, make sure somebody has a big check mark, that they're not going to run out of money, including all their, assumptions of buying a a recreational piece of property or buying houses for kids, whatever the case might be. But what is the tax that would be due today if they were no longer around? And what would be the tax at life expectancy? And also, what that does is it helps us look and see that there's likely a bunch of never spend money that they're only being taxed on. Can we use that never spend money to acquire something like tax exempt life insurance to preserve the entire estate, either for family or for charitable purposes? And that's where this idea, Joseph, comes about being an accidental philanthropist, that we often accidentally find out that people can be extremely generous, often by converting taxes into charity.
Now, at what point should these types of conversations be had? I mean, obviously, on the deathbed, it's a little bit more difficult. After somebody has passed away, there may be some things you can do, but again, it's problematic. What's your experience with this?
Well, I would say that the sooner the better. I always say that the best time to do all of this is while the sun is shining. Most people are really looking at being philanthropic, at least in my world, when they're sort of 50 years of age plus, right? Where perhaps, their kids are grown up more, they don't have the same debts that they had when, they had a roof, mortgage or kids' education, etc. And they may have acquired certain assets where they feel comfortable, and now it's about feeling a certain sense of responsibility to pass along, that capital in a socially responsible way, or especially to create the values that you want for your children, and even more importantly for your grandchildren, by showing them how important it is to be involved in causes that are important to the family, let's say to the G1, mom and grandfather and grandmother, and also to get the adult kids involved as well. And the earlier that you can do that, I think that you really do establish a beautiful message to your future generations. And then again, if it can all be done in a very tax efficient way, it makes it even nicer.
I love that. You're basically sharing your appreciation for the people around you. You're sharing the need to be connected and invested in your community as well. And if you can share those values and morals at a earlier age, I think about it with kids, getting them involved in allowances, teaching them about responsibility. It's the same type of thing when your kids are 40 years old and you're 60, right? When it
Right.
comes
So
to
I have,
philanthropy.
yeah, I have some clients that we've set up. There are different things you can set up. You can set up a private foundation, right? which really requires you to have significant charitable money to set that up because there's fees to get it set up and annual reporting, etc. Or you can set up something called a donor advised fund. That's when you borrow a structure of, let's say, either a community foundation like the Toronto Foundation, Vancouver Foundation, Winnipeg. There are all these foundations that are set up, and you can actually put your own named foundation underneath their umbrella. And it's a beautiful way to sort of have a one-stop where you put money in and you get one charitable receipt, but that money can now be distributed to any registered charity in Canada. We have a lot of families do that, Joseph. And then as a birthday present every year for the grandchildren, they'll say, here, I'm giving you $1,000 to give to any charity that you would like in Canada on the condition that you do some research on it and find out about it or potentially get involved with it. I mean, the money's already been receipted, it's sitting there in the fund, but it gets children or grandchildren involved in a beautiful, beautiful exercise about giving back and plugging them in and getting them involved. Look at the average 13 to 17-year-old right now is spending anywhere between 5 and 8 hours a day on digital technology. You know, when we were growing up, I was playing road hockey all day, you know, trying to get in. And so whatever we can do to get them off of that and get them into something that's more, more important in terms of to the world at large, I think it's a great, great thing to do.
Oh, I absolutely love that, Mark. A couple weeks ago, my kids were on Roblox. It's a sort of a computer online gaming system for the children, and they loved it so much that I said, okay, if you love it so much, let's buy a stock in Roblox. So we saved up their money, we bought some investments, we did a little bit of work on it, and it's great. Every day they ask me about the stock price, and we talk about what pushes it up and down, and that's stock investing. But if you could do the same thing with philanthropy and get the kids actively involved, now they've got skin in the game. Now they're emotionally invested in something. Just a wonderful, wonderful thing to pass on. I love that idea, Mark.
Yeah.
Can you can can you tell me a little bit about the mechanics of actually contributing to a donor advised, what are they called? A donor
A
advised
donor
fund?
advised fund. Yeah, there's either a private foundation where, again, somebody would pretty much have to put like $1 million to set up their own private foundation. Well, let's talk to civilians or more people like us. A donor advised fund is really a public foundation, and you just happen to be putting your named fund underneath it.
So what would basically happen is you would take your cash, you would contribute it to this foundation. I know Edmonton has one too, the Edmonton
Mhm.
Community Foundation. So you take your $1 million, you would make the donation, you would get a charitable donation receipt for $1 million at that time.
Correct. And I'm just going to suggest, Joseph, that the most Canadians, when they do giving right now, they normally give cash, checks, or credit cards,
Mhm.
right? That's pretty much the way things, but in reality, that's the most inefficient way to give to charity. At least it's the most not cost effective or tax effective way. And an area that, there have been about 25 different pieces of legislation that the government is introduced since 1995 to allow Canadians to be more charitable in a way that pays back. And one of those, which remarkably so few people know about, is that you can donate appreciated securities to a donor advised fund. And instead of paying capital gains taxes, you pay no capital gains taxes and you get a charitable receipt for the full amount of your donation. Once that money is now sitting in your fund, so let's just use an example. Let's say somebody has they can give $50,000 of cash, Joseph. But in order to do that, they'd have to make 100,000 to have 50 to give in order to get a charitable receipt to save them about $25,000. But if they had $50,000 in appreciated securities, and everybody has some mutual funds, ETFs, some stock, segregated funds, if they took $50,000 of mutual funds that, let's say, had a cost base of $10,000, so there's a $40,000 gain. If they would have sold those, they would pay $10,000 or just over $10,000 of capital gains taxes. But by donating the $50,000 of appreciated securities, there's no capital gains tax, and they get the full receipt for $50,000, which offsets again about $25,000 of their tax. Now,
Yeah.
in Canada, at least here, that when it comes to charitable donations, you can only ever deduct up to 75% of your income tax. So 75%, you can't do the full amount. So any amount that's over the 75% can be carried forward for up to 5 years. So what that means, Joseph, especially for your accountants and your professionals who are on the call right now, if they have any clients, let's say the fall comes, it's September, October, November, December, whatever, and you know that there's going to be a tax bill that's going to be due in April. There's going to be a tax bill in April. Let's just say it's $50,000. And you know that they're sitting there with a large amount of non-registered appreciated securities that has a significant gain. Wouldn't it make much more sense to take $100,000 of appreciated securities that fully doesn't even all belong to you, because the gains belong to the government, and
Mhm.
put $100,000 into a donor advised fund, pay no capital gains tax, get the $100,000 receipt that could offset 75% of your tax bill. And the balance is carried forward for up to 5 years. And now you've got, instead of having a $50,000 tax bill, now you have $100,000 of charitable money that's sitting in this donor advised fund. It's professionally managed by these community foundations, which means that your charity actually earns interest every year. So one foundation that we have a charitable fund in, the return last year was 10.2%. That means if I have
Wow.
$100,000 of charity, the next year I have $110,000 of charity that's sitting there. But by law, you have to distribute some of that money every year. It's generally around 3.5%. 3.5% has to be distributed to any registered charities in Canada. But if you're making 10, that means the idea is that that money should continue to grow in perpetuity. But along the way, you can continue to drop little gifts into your donor advised fund to save taxes, either more stock or could be cash, or you can actually use life insurance inside your donor advised fund as well. And a lot of people don't know that. You can actually have a donor advised fund not only own insurance, it can be the payer of insurance, and it can be the beneficiary of that insurance as well. So it's a wonderful way to create transformational charity just by using money that you've got currently sitting in your donor advised fund.
So are what you saying is what you're saying that you could actually have the donor advised fund, or by extension the foundation, the public foundation, actually be, for example, the beneficiary of the life insurance policy, so that when you pass away, they basically get the death benefit, the payout. And you could probably do it where, annually you're paying the premiums, and those would be donations every year, so you get a credit for that. Or you could just, have your actual assets within the fund pay the premiums, and then they get the payout. Is that how it would work?
Joseph, you're a very good student. You are absolutely right on both accounts. So it can either be new money that comes in to fund
Mhm.
that policy, or it could just be using the money that's already inside the donor advised fund,
Oh,
funding the
it's interesting.
policy.
So
So
there are no restrictions then on the funds within the donor advised fund to be spent on things like life insurance policies, investing in that way.
right. So that's just another asset that a charitable foundation can own. And I want to point out something that's very interesting when it comes to donor advised funds versus having a private foundation as well. The fees are extremely low. They're really a resource for communities to help perpetuate social responsibility and the good use of capital. So the fees are very low. As I said, they're professionally managed. Plus, you have somebody there who almost acts a bit like your consigliere. In my case, I can give away as little as $100 to a charitable organization. So I just send an email to the person over at the foundation and say, here, I'd like to give $100 to the Humane Society, or 100. Somebody's doing there's a cancer ride to fight cancer or whatever. So they'll send that check to the organization from our family foundation and notify the recipient on where that money is coming from. But what's nice is I only get one charitable receipt every year. So instead of looking around at all the,
I
all the
love
different
that.
places, you just have one address. The other thing that's also important is people who have private foundations, their foundations are actually public. You can go onto the CRA website and see everybody's private foundation, exactly who's on the board, how much money is in there, and who they've given their money to. Whereas if you have a foundation underneath the auspices of a public foundation, your foundation is completely anonymous. Nobody knows anything about what you have in it or who you've given money to. So it's a very efficient way of also distributing money in a way that's also very confidential.
Oh, I love that. Now, Mark, the other thing that you've done, and you gave me a copy of this in advance, but you created a list of actually 15 ways in which you can be philanthropic using insurance strategies. So 15 different possibilities. We've just touched on a few of them already. Mark, is it okay if we just touch on a couple more from this list and you just give us sort of the Cole's notes on how they work or what they are?
Absolutely, I'd be happy to.
Okay, and by the way, you're doing a fantastic job holding that phone up there.
I'm
This
so
is,
nervous. I'm glad I didn't have too much coffee. Otherwise, we'd be shaking along the way as well. So,
I love it. I love it. Yeah, just so everybody in the audience knows, we are recording this session in a video format as well for anybody who might have missed it. So you can pass on the link to your friends. I'll be posting the link on LinkedIn a little bit later. But just to reset the room, we have Mark Halpern, CFPT PMFAP, talking about philanthropy and key insurance strategies. Thank you everybody for joining us, and we're just going to dive into some of the potential strategies that he has listed on his top 15 list. So we talked a little bit about well, let's go to your first one. Life insurance policy donation. Donate a new or existing policy to create a large legacy gift or save substantial taxes now or in the future to offset estate taxes. We've talked about the concept of donating it through a foundation. Anything you want to add in respect of just a personal donation?
yeah, absolutely. So, for professionals who are sitting with their clients, they're generally getting an inventory of whatever assets they have and liabilities. And often, what we found is there are many clients that we meet who have old life insurance policies that really they don't really need anymore. In other words, the benefit would not move the dial on their current estate planning. And often what they might do is either cancel that policy, or maybe what they can look at doing is actually donating that policy to a charity that they are passionate about, or to a donor advised fund. And here's where there's a really great opportunity. And that is an asset that they have. And I'll give you an example. We have a some people that we met. They had a $250,000 life insurance policy that they no longer needed. As a matter of fact, they wanted to cancel it, Joseph. And I
Wow.
met with
Yeah.
the accountant and I met with the son. And instead of canceling it, I said, why don't we donate it to charity? So they were able to take that $250,000 policy and with an independent actuary actually get an actuarial evaluation on that policy for $87,000. That means that's the fair market value. So they donated the $250,000 policy to their donor advised fund, received an $87,000 charitable receipt that helps them offset about $43,000 of taxes now or over the next 5 years. And going forward, they pay the premiums for that policy and get a charitable receipt for that. So you've saved them taxes today, and you're saving them taxes going forward, and you've created a $250,000 gift that family can use going into the future. That's taking something and turning it into taking nothing and turning it into something. That would be donating an existing policy. Okay.
Now, just to clarify, in that example there, you were mentioning there was an $87,000 cash surrender value. Had they just closed the policy down, does that mean they would have $87,000 in their pocket? And is
No,
that what you should?
actually, Joseph, that did not have a cash surrender value.
Oh,
It used to be that when it came to valuations of policies, the policy was only valued at whatever the cash surrender value was. That has changed. Now you can get actually a fair market valuation, meaning this couple they happen to be in their mid 70s. So there's a $250,000 future payout, right? And if you look at their life expectancy and their health, that's also a big indicator. The worse their health, the better, because it reduces their life expectancy. How much would somebody pay for a future $250,000
Got
payout,
it.
let's say a future bond? So the actuary, and this has to be done by an independent actuary, looks at all of the factors, the health, life expectancy, the replacement value of the policy, and somebody would have to pay $87,000 today to get that $250,000 asset. So it was actually a fair market value, Joseph, not the cash surrender value.
I love that. And if you wanted to increase your tax savings, all you have to do is get grandma and grandma to take up marijuana and go skydiving. Then you can double the cash impact, right?
Well, it's one of those icky things. It actually works out better. The worse the person's health is, the higher the valuation, right? Because it is based on life expectancy. But we see this all the time. And that's why even when you're doing this inventory for your clients, in Canada, there's about $7 billion of term life insurance that actually gets collapsed or falls off the book each year in Canada. $7 billion. Well, if your client happens to be philanthropic or would be open to it, and let's say their health has gone awry, these policies allow you to do something called conversion. You can actually convert a term policy into a permanent policy at any time without any medical evidence. So imagine somebody has a policy, they're going to cancel it, but instead they get this policy converted, get a valuation on it, and now donate it to charity. Suddenly you're finding a great way to get a great fair market value on that policy and either continue to pay for the premiums, or we work with a number of charities what will actually pay the premiums for that policy going forward, or have a donor within, or they'll have a pool of money to pay those premiums going forward, because the IRR on those policies is so great that it's a wonderful investment versus sticking it into one of their GICs or something, earning 1% with inflation at 3.
Now, Mark, how common are the conversion features in term policies? Do they all have them, or is it just a few?
Pretty much. It's pretty universal, but it has to be done by a certain age often. These conversions are generally up till age 65. Some are up till age 75. So each policy is different. And each situation has to be looked upon on its own merits.
And is there generally some conversion costs, or is it just a change in policy amount or fee
Yeah,
amount premium?
no, it's a change of premium. There's no cost for any policy fee whatsoever, and we've been able to create some substantial gifts with the hospitals that we work with and universities that we work with, and for just donors who have something that they no longer need, where they're feeling they would like to do something significant. And often those charities, it used to be that charities would only recognize somebody for a realized gift of cash, let's say today, but there's a whole movement towards recognizing people for planned legacy gifts now, where
Mhm.
organizations will recognize you during your lifetime for a future gift. But that would be the idea of donating an existing policy or a new policy. Or, Joseph, imagine that your client is sitting there and they've got a $500,000 estate tax that is, it's a fait accompli. There's going to be $500,000 of tax, which is nothing today when you think about the tax on registered assets and investment real estate, etc. So if they're charitable, why not look at acquiring $1 million life insurance policy today, right? And having a charity be the beneficiary of that policy. So now upon death, the charity would receive $1 million. The estate would receive $1 million charitable receipt. And in the year of death, you could actually, with charitable donations, offset 100% of tax and actually go back a year previous as well. So it's a very, very efficient way of creating a lot of charity and saving a lot of tax. But that would be the way that you could use insurance now, existing policies, or getting new policies for charity.
Oh, I like that. A key point you brought up there is, instead of being limited to basically 75% of your total tax, the year of for your final return in the year prior, that cap is knocked off. 100% can be written off. Is that what you're?
That's correct, Joseph.
Okay. Well, that's fantastic. Thank you very much for that, Mark. Um, one of the other No, I'm going to talk about that in a moment.
How about CPP? I think we've got one there that says CPP
Number 4,
Philanthropy.
let's
Yeah,
do it.
to me, it's such a no-brainer. It gets me very excited. Something we created back in 2017. And that's what happened was, all my great ideas come in the morning, when we're all getting ready for the day. But, in Canada, when you turn 65, you're entitled to receive CPP, Canada Pension Plan. And between a husband and wife, it works out to about $26,000 a year for CPP. I would suggest that the majority of my clients do not need CPP. It's a small number. If you did, it's for them. It's something they're just going to be taxed on. They're going to reinvest it and be taxed again. So we came up with this idea of how can we use CPP or government benefits to create an enduring legacy for a family and save taxes. So we looked at it from 3 different ways. So your clients who are sitting there getting $26,000 a year, they could actually acquire a joint last to die insurance policy for about $1.5 million for that $26,000. If they make the charity or their donor advised fund the owner of that policy from day one, and the beneficiary, then the $26,000 of CPP is considered a charitable donation. Boom, you have no tax on your CPP, but you've created a gift of over $1 million for charity. Alternatively, take the CPP, pay the taxes on it, acquire the policy, but make a charity the beneficiary of that policy on death to create a $1.5 million charitable receipt to offset $750,000 of estate taxes. Or the third option would be take the CPP, pay the taxes, and get the $1.5 million policy and make your children the beneficiary of that and donate your registered assets, your RSPs and RIFs, which would be taxed at 54%, and give those to charity. All of a sudden, you've dialed up your kids' inheritance by about 50%, because if you had $2 million of registered money, your family's only getting $960 of that upon the second to die of a husband and wife. Here they're getting $1.5 million, and donate that $2 million of registered money to charity. And you're remembered for giving $2 million to charity, and your kids are getting a 50% lift on what you would have given them anyway, all from using CPP.
So what you're saying is we need to go after the kids and get all the kids to, hey, talk to mom and dad about starting to institute some of these plans. And one of the things that I really like about this, the CPP plan here, is you're basically aligning future inflows of cash with a future investments, essentially, or future donations. So it's simple. They match up. They go together. And as humans, sometimes if we don't have things simple that match up like that, we just forget to do it. And this way, it's sort of like exercising almost. You get into the routine and you build something great.
I love that, Joseph. It's true. People like to have a check mark. They like to know a box is checked off. I've got something I'm responsible for 10 years and that it's done. Or I've allocated this amount of money to a certain strategy and I know I've got it covered and it's going to be a universal amount that comes in. That's exactly how this works. So if you don't need that CPP and you are philanthropic or you want to be philanthropic, it's a wonderful strategy. We show that to singles, let's say, a widow or a divorcee or a single person. And if they don't need that money, they love creating charitable work, utilizing that money that's just coming in and out.
We're going to open up the session to questions if there are any fairly shortly. So if anybody on Clubhouse there does have a comment or a question they would like to throw out there, I've got the hand feature raised or on. So just raise your hand and we'll bring you up on stage. Before we get to the questions from the stage, though, Mark, are there any other ones from your top 15 list that you're particularly enamored with, or you really think should be discussed today?
Yeah, one that we've created is a concept called the gift maximizer, and that's where people think that life insurance, when used for charity, can only be there'll only be a benefit when somebody dies. So it's kind of can be sometimes a morbid conversation. It's a death situation, like life insurance will pay out on somebody's death, but you can actually have a benefit from an insurance policy while you're alive for charity to actually create a cash flow for that charity while you're alive as well. And that's something we've sort of put together. We call it the gift maximizer. And it really works very easily, Joseph. And that is with a permanent whole life insurance policy, there are two components, right? There's a death benefit, and there's also something called a cash surrender value. I like to equate it with real estate. Like with real estate, you have the market value and you have the equity. So with life insurance, it's the death benefit and the cash surrender value. Well, with these types of policies, they produce a dividend every year, and they've been producing this dividend for well over 100 years. And that dividend for a lot of these companies right now is in the 5 to 6% target rate. But most people in Canada will take that dividend and they'll use it to buy more paid up additions. In other words, instead of taking it as a check, they'll use it to buy more life. It buys more life insurance, and it also increases the cash surrender value. But one of those dividend options is to take a check every year. The problem is if you own that policy personally and you take a check of that dividend, you're going to pay tax. But if the policy is owned by your donor advised fund or by a charity, then the dividend that's produced every year is going to a nonprofit, which means that there's no tax, in which case the charity can actually receive a benefit while you're alive and a legacy gift at the other end. So I'll just give you an example. I was working with a 46-year-old philanthropist, and she wanted to create a nice legacy gift for a charity that she was sitting on the board of. And what we did was we created a gift maximizer where $1.2 million of money would be given to that charity during her lifetime, and there'd be a $1.7 million legacy gift when she dies as well. So that's $2.9 million of benefit. And the cost to her over a 10-year period of time was only $330,000. So
Oh,
her net cost is now, if she would have used appreciated securities, we could have brought that cost down to probably about 200,000. But for $330,000, she's creating $1.2 million of cash flow, on average about $25,000 a year to charity, and a $1.7 million legacy gift. And that's, again, using the power of life insurance, where a lot of people don't understand how it works and how it can be utilized in somebody's estate plan.
Oh, that's fantastic. Now, Mark, I want to throw it open to some questions from the audience. But I was just curious if anybody else wanted to take a look at the listing of your top 15 strategies. There a place where they could find it, or
Yeah,
how does
I
that
would
work?
like, Joseph, please, anybody, we actually, just to give you a bit of a background on where we've been going with this, we came up with a pretty audacious goal, Joseph, before COVID, that we wanted to create $100 million of new charity every year, working with clients, working with the donors of nonprofits, and working with allied professionals like accountants and insurance and investment people. We finished at just over $61 million at the end of December. So what's happened, it's been great, but we've also, through our professional work, have spoken in a lot of association and foundation events where professionals have stepped forward and said, Mark, we want to be involved with this. I manage $500 million. I've never spoken to any of my clients about philanthropy. So we are now collaborating with professional advisors. And my new goal is to sort of create a community across the country of 100 professional advisors and nonprofits. And if each of us can be responsible for creating $10 million of legacy gifts, often by converting taxes to charity, Joe, that's $1 billion a year. That's where
Oh,
I'm going with this. So that gets me excited. So anybody who wants to reach out, they can send me an email to mark@WealthInsurance.com. They can go to our website and be in touch with us. But we've created a lot of one-pagers on a lot of the topics that we've spoken about today, where it's a case study, very simple to understand. We also have identified, besides cash, checks, and credit cards, we have a list of over 20 other ways to be much more generous with less cost or more tax efficiency, including 15 key life insurance strategies, which is really our wheelhouse. And we'd love to share that with your viewers and your listeners, because this is really about, there's two ways for me to give charity. I can either write a check myself, or we can teach other people how to create that money. And hopefully it all goes to the same place of merit to create lots and lots of good in this world, often by using the Tax Act to our benefit.
Well, thanks for that, Mark. I'm going to open it up to our first question. Caitlin Butler, if you wouldn't mind unmuting your mic, go ahead, ask your question or make your comment. Caitlin, I've just realized with the way we've got technology set up, Mark isn't able to hear your comments. So I'm just going to have to repeat your question. But Mark, she started off by saying you're doing a great job.
Thank you.
Caitlin's question is, what is sort of the minimum dollar threshold for participating in a donor advised fund?
Great question. First of all, just know there are donor advised funds. The banks offer donor advised funds. The community foundations offer donor advised funds, but it really depends. It can be as little as $10,000, right? To get started, to open it up. That means a $10,000 contribution. You get a charitable receipt. And again, you can give that money to any registered charity in Canada right away, or at least 3.5% per year. But most will be at around $25,000. A lot of the community foundations. And then there's questions about restricted funds and non-restricted funds in terms of how the money is used, because they're trying to keep that money in. And then there are foundations or donor advised funds that are just flow throughs, money in and money out. I know that for one organization, I'm on a trustee at the Jewish Foundation of Greater Toronto. I'm also the chair of the professional advisory committee there, and we're trying to encourage younger people to start up a donor advised fund. So we have in place for anybody 45 years of age and under, it's only $5,000 to open up a donor advised fund. And I will tell you, it's a real kick. Like, you have your own fund, in our case, we have the Mark and Rhonda Halpern family charitable fund. And you don't have to be Bill Gates or Warren Buffett to be a philanthropist. You have your own foundation. We think it's restricted to wealthy people, but anybody can do it, and it's a great thing to do.
Great. Okay, so Caitlin says thank you, and she's got one more question for you, Mark. What is the average management fees for these donor advised funds?
Very, very minimal. It depends. It depends on what organization. And by the way, there are some other funds like Canada Gives, for instance, where you can actually, if you're in the investment business and your client wants to start up a donor advised fund, they'll provide you with the structure where you can still be managing your client's investments. They're charitable investments according to how you invest their money under the auspices of this structure. So it really ranges depending on how much money you're putting in, but it's generally around 1% or 1.25%, let's say up to $1 million, and it can reduce from there. So they're very efficient. But when you think of the benefit you're getting of having your own foundation and a charitable receipt and a place to sort of have your concierge service, it really is a very, very valuable planning tool for a family.
Great. Thank you very much,
And
Mark.
I'm happy, Caitlin, if you reach out to me, I'm happy to provide you with information on all the different foundations, either community or bank or people like the Canada Gives, and help you with those introductions.
Caitlin loves the overall simplicity of it and being able to deal with it in one shot and not having to deal with people every day.
Yep.
Thank you very much. Thank you very much for that, Caitlin. Just wanted to mention Caitlin Butler is actually a co-owner at Video Tax News with myself and our other sister Sheena. She's so very, very happy you're out here, and she's also my sister too. So sucks.
Wow,
to you, but
there's a little nepotism. Okay, I don't know. Is she entitled to receive valuable prizes at the end of this? Like family members or?
Totally, she can receive prizes. Okay, Katie, we'll talk about it later. But listen, we've only got 3 minutes left,
Oh,
so
no.
I know Justin had a question as well, Justin Manning, and I gotta say, Justin, plant-based professional, you're gonna live forever. But you do have a comment or question about life insurance policy. So if you want to just turn off your mic, Justin, I'm gonna have to repeat your question to Mark's, but you're on the stage. Go ahead.
I can hear this.
Connected on LinkedIn. I've been a financial advisor, life licensed since 2016. I just want to sort of give you some recognition. I'm absolutely in love with everything that you're doing in this space, and your personal story of how you started with your father when you were young. young is sad and inspiring all at the same time. And I just wanted to share that I'm absolutely in love with everything that you're doing in our space. Thank you.
Thank you. Thank you very much. Justin and Joseph, I heard that. I could hear the whole thing on my phone. So you don't have to repeat it. Justin, thank you. And I want to tell you that it gives me tremendous pleasure getting other advisors to be inspired by this and aspire to create something that involves strategic philanthropy in their planning. And I really encourage you, reach out. I'm happy to send you, our one pagers and our tax letter digest. And if you want to step up and be one of those 100 that are going to create $10 million a year of legacy plan gifts, well, we want to have you as part of that community. And it's not so difficult. It's just knowing some basic, getting some wisdom and knowledge around this. But once you get excited about it, it's such a rewarding thing as a professional, because it really does bond you with your clients in a way that you normally wouldn't, and opens doors to talking to them about other ways that you can help them. So I really appreciate those comments, Justin.
Well, I don't think there's any better way to end off today's show than with those inspiring words, that nice connection. Just want to thank everybody for joining us here today, especially Mark, who had to hold up his phone to his face throughout the entire. We're gonna have to put a cast on that, man. But
my arms, yeah, it was worth holding everybody up, Joseph. It was really it was worth it.
Oh, absolutely fantastic. Thank you very much, Mark, for sharing your time with us. If anybody would like to connect or follow Mark on LinkedIn, he is definitely there, so check him out. You can follow there. I'm not sure if he's going to try out Clubhouse again one of these days. Hopefully we can get him out here. There's a lot of great thought leaders on Clubhouse, and Mark, you're definitely one of them. So hopefully we can get you out again, or you can participate in other conversations. But other than that, we have come to the end of the show. Mark, any final words before we draw the curtains?
So thank you, first of all, Joseph, for having me. And it's great to have people who are interested step up and want to learn about this. I just, I would say as my parting words that it seems like there's a lot to learn here. Again, being on the other side of investing 30 years of my career, it's a lot easier for me, but I really do recommend that people learn about this and start putting it into their professional practice. But the one thing that you can't do is you can't ignore it. I really think it's best to collaborate with other professionals. We're living in a hyper specialist environment right now. It's not possible to be a specialist in everything. So I believe be a hyper specialist in one thing and surround yourself with other hyper specialists. So please, we love to collaborate with other advisors. Just don't ignore it. There's just too much on the line to be lost from your clients by way of taxes, by way of not being able to create enduring legacies, and by you of being sort of the gatekeeper to help your clients achieve all of this. So it's a very rewarding part of a professional practice. I encourage everybody to invest some time in it.
Thanks again, Mark. Like I was mentioning, we just appreciate your time so much. We appreciate your words. We appreciate everybody who joined us here today. We're going to close it off. Thank you, everybody. When you can, if you can, please share a little bit of kindness. Philanthropy is a great way to do it. Thanks again, Mark. Wishing you all just a fantastic day.
Thank you so much, Joseph. Take care, everybody. Stay safe and well.
The preceding information is for general informational purposes only and deals with dynamic, time-sensitive, and complex matters that may not apply to particular facts and circumstances. Information provided should not be relied upon as a substitute for specialized professional advice in connection with any particular matter. For more details, see videotax.com/disclaimer.